Today I'm revealing a powerful swing trading strategy, which implies finding points of inconsistency on a market. We'll use the hourly and the 4-hour time frame, and we'll monitor the previous day's highs and lows. And we'll use one simple indicator, Stochastic, to find divergences. So like, subscribe, and stick around for the full video. The first step is to find points of inconsistency between price action and the stochastic indicator. This happens when the price action is seeing lower lows while in a downtrend, but the stochastic is not reflecting that move. This is called a bullish divergence. And when the price action is making higher highs, but the indicator remains firm on the changes and forms lower highs, you have a bearish divergence. I'm a big fan of divergences because this type of signal warns you about a possible shift in momentum. When you spot such a situation, you must take a closer look at what is really happening. Now, regarding the settings of stochastic, I use these periods, but these are not set in stone. There will be different settings for different markets and even different settings for different time frames. You may need to slightly shorten or increase the look-back period to find the optimal divergences. So this is the first step. You look for situations when price reaches a new high or a new low, but the stochastic indicator doesn't. Essentially, it reveals a shift in the market momentum. Markets are driven by momentum, and the momentum is the force that oscillates between highs and lows, and thereby bringing the changes in the price action. Traditionally, this would indicate that the price direction is losing momentum and is priming for a reversal. But by its own, this can also prove to be an unreliable trading signal. Many divergences fail, and if you don't have a good filter to time your entries, you'll risk taking a lot of poor quality trades. My best filter is the previous day's high and low. This indicator reveals the previous day's high and low on a chart. Not many traders are paying attention to these levels, but in trading, the previous day's high and low are important reference points, important support and resistance levels. In an uptrend, price breaks above the previous day's high and continues to trade above that level. In a downtrend market, price breaks below the previous day's low and continues to trade below that level. Trading ranges are easily spotted with this indicator. These are formed when the price fails to successfully break the previous day's high or low. Breakouts work better when the price is above or below yesterday's range. Trend following strategies also work best in this situation. So here's the trading plan. You trade bearish divergences when price makes higher highs, while stochastic makes lower highs, only if the price breaks the previous day's low. When the previous day's low is broken, you look to short the market. And you look for buy signals when you spot a bullish divergence, when price makes a lower low, while stochastic makes a higher low, but only if the price breaks above the previous day's high. We are trading pound yen on the 4-hour time frame. I see a potential bullish divergence, so we'll aim to trade the change in direction from a downwards move to an upwards move. Price creates a lower low, and at the same time, stochastic is making a higher low. The indicator is not following the price down, suggesting the move lower is weakening and losing momentum, resulting in a possible move higher. As a tip, the high-low indicator will actually pinpoint the low of the day, which is the actual low of the divergence. You'll enter after a breakout above this day's high. Here it is. Now the signal is confirmed. Loss of momentum on the downside, plus a bullish breakout above the previous day's high. Stop loss placement is subjective. I initially place it below the previous day's low, and I'll try to move it to break even when price is making higher highs. As for take profit, as we have a wider stop, we look for a risk-to-reward ratio of 2. Let's continue. Price moves higher, and I see some signs of weakness. This is the first possible bearish divergence, which indicates a potential change in direction from an upwards move to a downwards move. Price creates a higher high, but at the same time Stochastic is making a lower high. So the indicator is not following the price up, suggesting the move higher is weakening and losing momentum, resulting in a possible move lower. When this low is broken to the downside, that's the confirmation we need to enter a short trade. Stop loss above this high, and we'll target this swing low. As you can see, just to be conservative, we'll use wider stops. In this case, you must lower your position size to accommodate the risk. For example, if you're used to trade with, let's say, 1 lot, use 0.3 instead. This way, you won't get your account overexposed. This is crude oil, and the same for our time frame. After a 3-wave uptrend, I spot a possible bearish divergence. The indicator and price action are out of sync, so it means that something might happening. Now here's the problem with this setup. The range between this day's high and low is quite large. This means a much higher stop loss, which might not offer a viable risk-to-reward ratio. In this case, you won't place your stop above the previous day's high. Instead, you'll place it above the most recent high. If besides the high-low breakout confirmation, you also spot a trendline breakout, that's even better. When a divergence forms and the price starts changing direction and also breaks a trend line, there is a higher probability the price is going to reverse. Being a swing trading approach, I prefer to use limit orders below or above the previous day's levels. In this case, we look to short below this low. Stop loss above this high, and we'll target a risk-to-reward ratio of 2. We move on. Price increased, but the Stochastic disagreed with the price action, so we have another possible bearish divergence. If we move to the 1-hour time frame, we see something that resembles a period of distribution. The highest point in our divergence would be the spring, the false breakout out of the distribution phase to remove weak players out of the market. We have the confirmation to initiate a short position when this low is taken out. And we also have a trendline breakout. When you see price action breaking this trend line, it could signal a shift in power from buyers to sellers. This way, my stop loss is optimized above the 2 breakout points. It would be placed above this swing high. And the take profit here, double the size of our risk. To avoid bad entries, you could also add other confirmation tools. Besides the high-low breakout and the trendline breakout, the location of the divergence could also make the difference between a good and a bad trade. In this example, I see a downward leg, but within a trading range. This bullish divergence formed at a clear support level. When price broke the previous day's high, we were faced with a decision. We had a gap up above the previous day's high, plus a rejection of support, and a trendline breakout. three confluence factors which indicate buying pressure. So, where to place the stop loss in order to obtain an optimal risk-to-reward ratio? In this case, I wouldn't place it below support. We are in the middle of the range, so the upside potential is somewhat limited. I'll put the stop below the up gap, and I'll target the upper limit of the range. And here's another example where our signal came at a major level. First, I see this previous support level, which turned into resistance. And there's our divergence, where Stochastic doesn't agree with price action. Price broke the previous day's low. We even had a trendline breakout, the third confirmation factor. If you trade markets that gap often, I advise you to place your stop above or below the last candle before the gap. In this case, it would be above this red candle, and will aim to gain double the amount we risked. For more advanced traders, you could also add volume into equation. Volume is often neglected, but could be of great help when it comes to analyzing divergences. To correctly read the volume, it must be seen in the light of what the price is doing. In this example, we identified the possible bearish divergence. Not the cleanest example, as the Stochastic almost made a double top, but still, it checks our conditions. Price broke below the previous day's low. Trendline breakout. And now look at the volume. So price was rising in an uptrend. A divergence appeared, but the volume was reducing on the second swing. This may reveal there's little interest, and that price may reverse. Look, we even had a divergence on the volume in the area of the highest high. I'll take this trade every time I'll see it. Stop loss above the previous high, and a risk-reward ratio of 2. And don't forget to move your stop to break even when price moves in your direction. When trading divergences, the key is to be careful and precise with your entry point. If you find a divergence, but the previous day's range is very high, skip it. It's better to stay aside and don't force a late trade. When trading divergences, the entry point and the risk-to-reward management are both important aspects. Use limit orders above or below the previous day's high and low to ease the process. This strategy has great potential because it uses multiple confirmations. A divergence initially signals a loss of momentum, but doesn't necessarily signal a complete trend change. But when you add other criteria and confirmation tools to your arsenal, then the magic happens. So don't try to enter early. Look for the other confluence factors, then make your move. If you want to see more videos like this one, leave us a like and subscribe. And check out our Academy program if you want to further level up your trading. Until next time.